This session, like I said, is intended to be a live Q&A. This is coming out of some feedback that we've gotten from a lot of our clients that have kind of enjoyed the 15-minute updates, those quarterly videos that we do on market strategy, and said, hey, really like, a 15-minute snippet. Would love if we could go into a little bit more strategy, our decision-making process, why we do the things that we do. And so we're calling this the halftime strategy session, really leaning into that whole sports analogy, 15-minute quarter. Certainly not tied to this name, but the intent is to do these around the middle of the month during the quarter and just really answer as many questions as we can or discuss hot topics of the day. The reason why we landed on Bitcoin for this one is there's a couple of funds that have come out that have made it a little bit easier for investors to invest in Bitcoin. And we thought it was really important to kind of get some information out there about what those funds are, what they actually mean. And so that's going to be the purpose of the conversation today. Like I said, it is a live Q&A. We do want to hear from you guys. To the extent that you have any questions, please feel free to type them into that Q&A box at the bottom, and we'll do our best to answer them. Now, I'll tell you, I tend to think of myself as a fairly intelligent person, but I am by no means an expert in every single thing. I will definitely try and answer as many questions as I can to the best of my ability. But if there's one thing I've learned, it's any statement I make, you could probably find a counterpoint somewhere online. And that's probably one of the first things that I want to address as far as disclosure is concerned. A lot of the information we talk about is going to be somewhat opinion-based, right? There's going to be some counterpoints out there. To the extent that we can find them, that is great. I will try and separate what I'm saying fact-wise from opinion-wise, but at the end of the day, our goal is to provide as much information as we can to our clients and their friends and family. And so any information that you take out of this really it should be taken as your own. And if you make a decision based on the things that I said, it's because I was just one source for you to make that informed investment decision. One other thing I like to point out for this particular conversation, I do have some exposure to cryptocurrency, including Bitcoin. I think as of this morning, I owned about $6 worth of it. But we'll get into why that would be a part of my personal portfolio and the decision-making framework for somebody that would make it part of theirs. So without further ado, let's just jump in. My name's Nick Brown. As I may have mentioned at the very beginning, I have two other partners, Brian Sack and Tim Smith. We at Granite Harbors, we specialize in doing holistic financial planning for small business owners and corporate executives. My particular area of passion is in asset management, investment management. That's why you have to listen to me right now, as opposed to one of my other two who are much better at speaking. But this is going to be applicable to what I really love about what we do, which is that investment management, asset management. So let's talk about Bitcoin. I want to give a quick snapshot, a quick summary of what it is and what it's kind of turned into, because at the very beginning, Bitcoin was really a thought experiment for transaction processing. It was not a quote unquote cryptocurrency that we know of it today. The whole intent of Bitcoin was just to be the widget, the call it the thing that was going to get passed back and forth to create a more efficient transaction processing system. And what they were really trying to solve and work on was, can we get transactions to occur immediately in real time while preserving anonymity of both parties and not having it rely on a centralized database? And Bitcoin, the underlying blockchain technology, is the software program that the creators wrote to address those things. And a Bitcoin was just what they called the thing that would get passed back and forth in order to record those transactions. And over time, people looked at the rules of how a Bitcoin came into being, and it started to gain a lot of popularity, mainly because there's only going to be so many Bitcoins that can be passed back and forth. They can be passed back and forth as many times as you want, but there's only going to be so many in existence. There is a degree of anonymity, right? Everybody gets to interact with blockchain anonymously, and it's decentralized. And so it was kind of a way for people to operate outside of the traditional financial structure. And so as it gained popularity, you had a lot of different cryptocurrencies come out there. If you go online now, you can see hundreds of different options. Bitcoin really is the most popular. It's the most well-known, follows closely by Ethereum, but there are numerous cryptocurrencies available out there. And so when an investor is trying to decide if they should make an investment in cryptocurrency, the first one is, well, which one, right? We're going to talk about Bitcoin just because it's the biggest and it's the one that most institutional investors have tried to find a solution for. Because as it's gotten more popular, a lot of companies have really tried to capitalize on some of what I would call the weaknesses of Bitcoin, which is you need a certain level of technological expertise to get into it. And it has really forced people to become their own bankers, so to speak. When you buy Bitcoin, you really need to keep track of what you got and make sure that nobody else can get it. That's a function that a bank used to do for most people by keeping your information behind a login screen, by making sure that they had accurate records of your finances. That's really what a bank does. And so to ease some of those technological restrictions, some institutional investors have come out with things like exchange traded notes or exchange traded funds to try and track the price of Bitcoin so that people can invest in it without having to make that direct investment. And that's a really key point that I wanted to hammer home, and why we wanted to do this presentation is because these funds are out there now, which seem like an easy way to make a direct investment in Bitcoin, but may not exactly be what most people, quote unquote, think they are. So getting into just cryptocurrency characteristics as a whole, when you make an investment in cryptocurrency, it's something that I like to call a speculative investment. Cryptocurrency right now is very speculative in nature. That word kind of gets a little bit of a derisive term to it, but I don't believe that's the case. What's really important when people are making a speculative investment is for them to know that it's a speculative investment, to know that, hey, there's a degree of risk here. And if things don't work out the way that I thought they should, I've got an exit strategy for that. Where most people get themselves into trouble is they make a speculative investment and don't have that exit strategy. One of the best books that kind of outlines that philosophy is What I Learned Losing $1 Million by Jim Paul. I would suggest anyone that's making speculative investments, pick up a copy. It's a very easy read, but it's got some great life lessons from a guy who was really at the top of his game from an investment standpoint, lost a ton of money and learned a lot of lessons along the way. And so when we're making speculative investments, we just need to keep that in mind. Hey, there's a risk. This is speculation. I am buying a highly volatile asset. And the reason why a lot of people have had trouble with that asset is the utility of it. Nobody quite knows. It doesn't create any cash flows. It doesn't, quote unquote, do anything other than operate mostly as a store of value. And that's where a lot of the perceived utility has come from, is people have started to look at Bitcoin almost as like digital gold. And the more people adopt Bitcoin as that digital store of value, the more growth potential it has. Alternatively, the more people realize that there's technological restrictions, the more regulation that comes into place, the more centralized it becomes, the more security concerns you have, the less growth potential you have. And that's just something that people should understand going into any investment, but particular cryptocurrency is, hey, what are my risks and what are my rewards? And am I making an appropriate trade-off for the two? So if we walk away from this conversation with anything, it's just, hey, when we look at cryptocurrency as an investment, does it fit my risk profile? One of my favorite stories is Elon Musk and Tesla put well over $1 billion into Bitcoin last year. And everybody took that as validation of the model and said, hey, look, this major US company is using Bitcoin. I got out of it a little bit later, but I also like to point out that out of $1 billion, that was maybe 1% of Elon Musk's net worth. And so when you make speculative investments, that's for people that can afford to make them in amounts that they're willing to basically lose. 1% is not that bad, whereas $1 billion sounds like a lot. So if you had a $10 million portfolio, you're talking about a $100,000 allocation to a cryptocurrency. I like to put that note in there because, hey, we want to put some guardrails up anytime we're making a speculative investment. Doesn't mean that they're wrong. It just means, hey, we want to have good practices in place. Bitcoin is extremely volatile. It goes up, it goes down. At the beginning of the year, it was at an all-time high. Somewhere in the spring and summer, it had gone down 40% plus, and now it's back up at an all-time high, which I kind of view as a good thing. What Bitcoin has really done for investors is it made it to where they're more willing to look at risk and analyze risk and realize that, hey, some of these assets that I own are going to be very volatile. And as long as I'm not overcommitting to them, I can be in them and I can really kind of reap the rewards of long-term ownership while absorbing some of the short-term negative impacts of negative volatility. People view volatility in a negative light, but volatility works both ways, right? A volatile asset can go up a lot and a volatile asset can go down a lot. So as long as we know that, as long as we're not committing dollars that we need right this second to that type of investment, it can be pretty fruitful. The other thing I like to talk about when it comes to Bitcoin and any cryptocurrencies, they're decentralized in nature, and that's on purpose, right? The whole value of cryptocurrency is it's this thing that no one person can control, but it creates a lot of unintended consequences. If you lose your password or you lose your private key to your private wallet, there is no one that you can call to reset your password and get it back. About 20% of all Bitcoins right now are lost because people either lost the hard drive that they were on, or that their private key was on, or their private wallet was on, or they've lost the private key, or some other security concern has occurred, which is another reason why you're starting to see these funds come out and help people invest in Bitcoin without making a direct investment in it. Finally, talking about utility, Bitcoin has utility, or any cryptocurrency has utility as a potential store of value, right? We talked earlier about it being this digital gold, and the more people adopt it as that, the higher the growth potential is. But there are still considerable risks. And so just making sure that people think those through and investors really understand what they're getting into should be incredibly helpful. So let's get into the exact reason why we wanted to do this. We took a long way to get here, but we want to talk about some of the funds that have come out, because there are now publicly traded, exchange-traded funds and exchange-traded notes that are designed to track the price of Bitcoin. But one of the big problems that the institutional industry has had is no one's been able to create something that accurately tracks what I call the spot price of Bitcoin, or the exact price fluctuations that Bitcoin has. So there's an exchange traded note out there that owns Bitcoin, but it trades at a fairly significant premium because of the fact that it doesn't just like buy and sell Bitcoin as much as there are shares that are created that exist out there. So when you buy that exchange traded note, you can actually be paying up to a 30% or even more premium over the underlying value of the Bitcoin that note earns. And so it can be an option for somebody that maybe doesn't want to go through the technological process of setting up a wallet and going through an exchange, or buying the Bitcoin themselves, but just know that you are paying a premium for that exposure, and it will own the underlying Bitcoin. The ETF that's recently come out does not own Bitcoin. It actually owns futures contracts on Bitcoin. And that's a really important distinction to make, because it doesn't actually own the underlying asset. It doesn't own the thing that people are trying to buy. It owns a derivative of that thing. And if y'all can harken back to April of 2020, during the midst of the pullback and the pandemic, and really kind of late March 2020, And remember when oil went to negative $35 a barrel, well, oil didn't go to negative $35 a barrel. Futures contracts on oil went to negative $35 a barrel because there was a market inefficiency, and oil ETFs that use those future contracts, everybody knew when they had to sell those futures, and the market was able to essentially take advantage of that. That's not to say that futures contracts are bad or that ETFs that use futures contracts to track a particular thing are bad. It's just that's an unintended consequence of using them, and people should be aware of that. So when we start talking about these funds that have come out, it's really important for people to realize that, hey, the thing I'm buying is not going to be the exact same thing as what I see on the news. It's not the same as owning a Bitcoin or whatever your digital currency of choice is. But one thing you are doing is you're reducing that technological friction, right? You're making it a little bit easier for you to get some exposure to it. But if you were to ask me, I would say if I wanted to own something, I'd prefer to buy the thing. That's just my personal opinion, though. Results may vary, and there's room for other opinions as well. So let's do a couple key takeaways. Cryptocurrency is a speculative investment and should be treated by such. Bought by people that can afford it and in amounts that are not going to create a financially uncomfortable situation. If we hit home runs, that's awesome. And if we don't, then we haven't put our financial security at stake by making that investment. The other thing is publicly traded funds that have come out may be good for people that are less technologically inclined or don't want to handle or don't want to deal with the hassle of setting up their whole platform to buy it, but it's going to come with a cost. And just make sure that you're aware of what those costs are and that you're willing to incur them. And then the last thing is, if you are making an investment, whether it's direct or indirect, just being disciplined about it because it's a speculative investment. And so making sure that we use it in an appropriate amount, that we're not allocating dollars that we wouldn't otherwise need elsewhere as part of a well thought together financial plan. So that's me talking a lot. I'd like to kind of turn it over to our participants and answer some questions. So if anybody has anything that they'd like us to address, questions they'd like to hear, I'd be more than happy to answer them. Looks like we've got a couple people typing some stuff out. So one of the questions that we can address is if people are looking to buy Bitcoin, where's a good place to get started? I'll tell you, if you're going to go into an investment like that, you want to do a little bit of research. There's a company, Coinbase, has created an exchange where you can go and you can sign up for an account, and they will help you create a digital wallet, and you can move cash into it and use that to buy Bitcoin. That's probably the most well-known, certainly not the only one or the only option, but for people that are looking to do stuff like that, that is a place that you can go. The key about making a purchase in cryptocurrency is you do have to set up that digital wallet. You got to have that thing that's going to store your Bitcoin or your cryptocurrency. And once you have that, then you got to be able to get some actual cash into your digital wallet. Once you've got cash in there, then you can reach out and you can actually buy cryptocurrency and interact with it and hold it. So when we talk about, another question that people might ask is, generally how to view a speculative investment, how much to make. I would say that when we're making speculative investments, when you're doing something like a digital currency or something where, hey, the underlying price is really based on, some event happening in the future, either wider adoption or continued less regulation, things of that nature. Really encourage people to kind of keep those to be a manageable part of your portfolio. When I say manageable, I would typically lean towards like 5% or less. because anything over that amount, now you're really kind of creating some uncertainty into the future success of your portfolio if that thing doesn't quite work out. But everybody's going to have a different risk tolerance and a different appetite. Some people would be happy just blowing the wheels off of that number, and other people would say, hey, you know what, this actually isn't even for me at all. So it really is that individual guardrails that you want to put up. I say 5%. That's my personal tolerance for something like that. Just because I know when I go home and I mention to my wife, hey, that thing that I bought, instead of being 5%, it's now 1%. She doesn't enjoy those conversations, and I like to limit that as much as I can around my dinner table. But individual results may vary, and so it's really just a personal choice. We'll give a couple more minutes. If anybody has any follow-ups, seems to be the two biggest ones. Got one other one about just kind of if somebody used an alternate platform, does it make any sense to do Coinbase? I'll be honest, I'm not going to make a recommendation over one platform or another. There's a bunch of exchanges, a bunch of platforms available. I just don't have the due diligence or expertise to have gone through every single one that's available. It's a personal choice. Whichever platform you can interact with the easiest, that's the most intuitive, that feels the most secure. But right now, I mean, there's a lot of people that are trying to get into that industry. And so if I was looking at a particular platform, whether it's Coinbase or Cash App or any other, what I would really say is just, hey, take a hard look at, their security policies, how difficult it's going to be for somebody to access your information or access your account, because that's one of the key takeaways about Bitcoin is it really is essentially a bearer instrument, just like bearer bonds were way back in the day. If you have it, possession's 9/10 of the law, it's yours. And so if somebody can get into your account and they can access your private key in your private wallet, they can take that Bitcoin and you're probably not going to get it back. So another question about taxation on Bitcoin. So the SEC is kind of not made a whole lot of, the SEC and the IRS really haven't come out to haven't provided a whole lot of clarity here. It's currently treated as a currency, which means if you buy and sell it, any gains are going to be taxed at capital gain rates. One of the interesting things though is as a currency, you actually don't have, as of right now, the same wash sale rules that you would have. So if you bought a cryptocurrency and then sold it later for a loss, you actually don't have to be out of that position for 30 days. You could actually book your loss and then go and buy it, the very next minute if you wanted to. But any gains that you get are going to be taxed at capital gains rates, either long-term or short-term, just based on your holding period. Another key fact on the whole taxation impacts are it's really up to investors to keep track of their cost basis and what they originally paid for their cryptocurrency. While there are exchanges and custodians that might have that information, it's really going to be on you as the investor to prove, hey, this is what I paid for it. So that when tax does come due, you're able to support what your cost basis was. And so just kind of keeping an independent record of that is extremely important. So one, I'd say more of a comment than a question, but talking about Bitcoin as opposed to a national currency, and the fact that the buyer and seller, supply and demand, are the ones that are setting the price. That's true, right? So Bitcoin is set by the market, similar to how a stock price is set by the market, right? Of course, those prices are based on some known information and some unknown information, right? The key difference between Bitcoin and say maybe a currency investment is a nation can't create more Bitcoin because it wants to, right? When you have a currency, the central bank can control the supply and demand of that currency. Whereas with Bitcoin, it's a much more finite, it's a much more known number. There's only going to be so many Bitcoins. They get created at essentially a set schedule, and it's going to come to a point in time where no more are going to be created. And so that is maybe one advantage that Bitcoin has, is the fact that you know how many Bitcoins there are going to be. It doesn't necessarily help from the price setting amount, but it does just make that a little bit easier to address. So you're not going to have to worry about blockchain dumping an extra 3 trillion Bitcoin into the market when they need it. That can be a pro, that can be a con, right? The less control you have over something, the more volatility that thing can create. Looks like those are all the questions that we have for now. So like I said, we really intend these to be quick snapshots. We're going to do these every single month. We'll pick some topics. If anybody has topics they'd like to hear us speak on, by all means, please feel free to send them to us. That being said, if anybody thinks of any additional questions, please feel free to reach out to our office. Either at the main number 832-461-0789. You can also email us info@graniteharbor.com. If you have a question or you think of one after this and we just didn't get to it, please feel free to reach out. We'd love to help anyone we can, as much as we can. But short of that, thank you so much, and hopefully everybody got some value out of this, and have a great day.